Hi, this is Nate Short, and welcome to my January 2012 short report. First of all, I'd like to say Happy New Year to you, and hopefully you feel like I do that we're going to be off to a great start here in 2012. There's a lot of positive things on the horizon, and I personally feel it's going to be one of the most exciting years of our lives. In this report, I'm going to cover basically three things. The first thing is some of the interesting statistics that we have now gotten from 2011 in regards to residential real estate here in Seattle and also on the east side. The second thing is I put together an interesting analysis that I think will help in gaining some insights in what's going to happen in 2012, so I'm excited to share that. And then lastly, I'm going to talk about some of the key learnings as I've been out in the field with some of my clients, helping them either buy or helping them sell their homes. As always, if you have any friends or family that are looking to buy or sell real estate this year, please keep me in mind. I'd be happy to send them information and to try to help them out as best I can. Okay, so let's get down to the statistics here that we learned from 2011 or that we've just gotten in. The basic the trend has been that inventory has been going down for quite some time, and yet buyer demand continues to just kind of putter along. In the east side and in Seattle, our active listings are down 24 and 27% respectively. So one of the things that we're seeing is that people have a lot less to choose from when they're going out to buy a home or look for an investment property. Second thing is our average time on market is down about 10 to 11%. So the homes that come on the market that are priced right and that are in good locations and good price points are selling quickly. I mean, in many cases we're seeing multiple offers. It just depends on, again, the location and the price. Closed sales are up 12% and 2% respectively, which is great because we didn't have any government subsidized programs this year to basically trick the numbers out. So one of the healthy things is while demand is better than it was, it still is not great. I mean, it's still puttering along. We haven't really seen the attitude of the buyer change. And then the median closed sale price year to date, I think it was down 7% and 5.3% respectively. So what we're seeing with that number is that there's still bank-owned homes, lower price point homes that are continuing to pull the pricing of the market down, but again, it's very pocket specific. In some cases, we've actually seen pricing that is appreciated, 6-7% this year. So it really is very price and location specific. The second thing I told you I was going to talk about was put together an interesting analysis on the inventory in Seattle as basically months supply of inventory and on the east side. And then I compared that to the appreciation schedule that we saw for the last 11 years and then correlated that to interest rates just to illustrate where we're at today, where we've been in the past, and then hopefully what the opportunity is for 2012. As you can see in 2011, now at the end of 2011, our inventories at 3.4 and 3.9% are pretty much equal to what they were in 2007, which was the height of our real estate market. Even in that year where the prices had started to go down a little bit, we saw 4.6% appreciation. Now keep in mind, interest rates, the average 30% interest or 30-year fixed interest rate was 6.34%, almost 2 full points above what they are today. Also, available listed homes. So I went back and looked at our total number of listings, and today that represents about the same as what we had in 2005, which is when we had the greatest appreciation ever in our Seattle area market at 17.28%. So that's interesting to me. If we could just get demand to pick up, we'd really see a lot of upside on pricing, I think. Also, interest rates, just to reiterate, are at all-time lows, 4.45%. I remember when I bought my house in Snoqualmie at 8.05%. That's almost a 4% difference. So on a $100,000 mortgage, that's another $4,000 that you'd be paying in interest every year. So that's an incredible statistic in and of itself. I think the key thing is what is going to happen with these distressed properties that remain on the market. What I'm seeing is there's a lot of Fannie Mae properties. We haven't seen maybe the unleashing of a lot of these bank-owned homes that are potentially coming back to the Bank of Americas and the Chases of the world. And so, if that is if that continues to be out there and those banks do start to say dump those properties, what could that potentially do to pricing? But what I've always talked about as well is, what is the replacement cost of these properties? And what we're seeing almost in every case is it's cheaper to buy than it is to build by quite a bit. And when you're out potentially renting, it's about 20 to 30% less expensive to buy than it is to actually rent. So some key learnings there. I appreciate any questions, or if you want to email me or call me, or have any of your friends email me or call me, I'd really appreciate it and be happy to give them the best information I can. Have a great year and make it a great one. See ya.